in Europe, we've seen a pretty good earnings season, above average level of beats there. But a lot of it's had to do with a foreign exchange rate tailwind. We think the outlook is for earnings to be continued to revise down as the macroeconomic outlook this year is pretty weak. And as we see headline inflation come down, but labor costs stay elevated, that's going to squeeze margins as well. In the US, earnings season has been a little worse. We've had profits coming down, we've had sales falling, we've had margins contracting, and the average earnings beats in the US has been much below average, actually consistent with where we usually are on the eve of a recession. So look, there has been pockets of good news, but we think the outlook is going to turn, and we expect downward revisions to earnings. And that means that from a stock picker's point of view, you're going to want to focus on picking really strong, resilient, quality companies.
And if we're talking about an earnings slope here, can you just talk us through the timing? Because I think many on markets think that this first half of the year is going to be somewhat dicey. We start to improve by the second half. So if we're talking about an earnings slope, is it very brief at this point?
It's difficult to say when the adjustment is going to come through and how long that will take. We do think, though, that there has been a lot of optimism about particularly the US and therefore the world as a whole avoiding recession this year. We think a US and a global recession will start this year. And if the market starts to realize that, then the earnings adjustments could be pretty quick. But what we've seen powering this rally over the last couple of months, if we look at investor surveys out in the last week by Bank of America or Goldman Sachs, you've seen the net number of investors thinking that the US will avoid a recession increase significantly. We think that's a mistake.
Yeah, Ed, what happened to you over the end of the year? When we saw you in December, I remember distinctly you said, we think that there is a path to a new bull market in the second half of the year, but we're not there yet. Now I'm listening to you and you're dismissing these surveys and you're saying the earnings look awful, and you sound so much more bearish, and you sound like you're convinced that the recession is pretty much in, even if we're not getting the numbers printed yet. What is it that really changed your mind?
Well, look, we do still think that there is a potential for a new bull market to start towards the end of the year, but it's just going to get an awful lot worse, in our opinion, before we get there. Perhaps one of the reasons why I think it might take a little longer to get there is that some of the inflation data under the bonnet that we're looking at in the US is coming on, in our interpretation, a little more hawkishly. I think the market is taking a slightly different view. But if we look at things like the median CPI rate in the US, the median price increase among all the items in the CPI basket in the US, that shot up again in January. It's hitting the third highest month-on-month reading since the early 80s. So we think there are perhaps a few more rate rises to come in the US than perhaps we thought when I last spoke to you back in December. But look, there is still a path we've got. We're ready, our checklist of what we need to see in order for us to turn more bullish, but it may not come until right at the back end of the year.